Hello everyone, and welcome to the very first of a series of videos. As you can see here, Financial Accounting Made Easy. The idea is, as the name suggests, to make it your life a little bit easier if you're a financial reporting student, be it perhaps on professional exams or be it at undergraduate level. The precise subject of this particular video, as you can see, is deferred tax, a much maligned topic, a topic that is often made unnecessarily difficult. What I'm hoping to do in this video is demystify deferred tax and make it more digestible and easier for you. As I said, this is the first of a series of videos. There will be more content to come, so if you like what you hear, then like and subscribe. You know what to do, and look out for other videos in the area of financial accounting / financial reporting. Now, these videos will be live and unedited, as it were. Live in the sense that it's a live recording. It's not about the quality of the video editing, which there won't be any. It's about the quality of the teaching content, and that's how you need to view these sessions. So let's get on with it. Deferred tax. What are we going to say about deferred tax? The governing accounting standard, that's if you're interested in IFRS, which is what most students are interested in, is IAS12. It is an accounting standard called income taxes. And therein lies the first potential bit of confusion, especially for those of you that happen to be based in the UK, like I am, because in the UK, the phrase income tax is used to describe the tax that human beings pay on their income. Well, IAS12 uses the phrase in the international context. Yeah, IAS12 uses the phrase income tax to describe the tax that companies actually pay on their income. It is the tax that in the UK we refer to as corporation tax. Internationally, depending on where you're based, you'll have something similar. So the point is, do not be confused by the terminology. What IAS12, the accounting standard, is about is accounting for corporation tax. Yeah, corporate tax, the tax that companies pay on their income. Really, this topic can be divided up twofold. You have the relatively straightforward area of current tax. And then you have the more sophisticated area, what this video is primarily about, deferred tax. Okay, so two learning areas, although there is a huge interaction between the two, as we will see. Now, the point of this is, of course, accounting for tax, not tax in itself. The actual calculation of the tax, that is a whole profession in its own right. That's a whole nother subject in its own right. That's to a greater extent a given in this presentation. What we're talking about here is how the companies account for the tax, and that's what IAS12 is about. So I suppose the message is, in terms of tax knowledge that you need, it's minimal. Yeah, minimal, practically non-existent. And to be honest, by the time you've reached a level in your financial reporting studies where you're actually thinking about deferred tax, you've probably got a rudimentary level of understanding, which will be more than sufficient for this lesson. Let me tell you the extent that of tax knowledge that perhaps you should have. Let's say you are a company and you are about to work out how much tax you owe. Your starting point is what I would call the accounting profit. Now, what do I mean by the accounting profit? Well, this is a profit that you will find on your SPL, your statement of profit or loss, otherwise known as the income statement or the P&L, the profit and loss account. Call it what you will, depending on where you are based. I'm going to call it the SPL, the statement of profit or loss. And in particular, the subtotal PBT, profit before tax. So that's your starting point, what I would call the accounting profit from your statement of profit or loss, the PBT, the profit before tax. You are probably aware, if you've had any exposure to the study of tax, that is just a starting point. Yeah, what you then need to do to that accounting profit is make adjustments to it. So here I am, I'm adding some things, I'm taking some things away, as you can see, making adjustments to the accounting profit to turn it into taxable profit. And that's the first thing to note, really, that a company's tax that they owe, their corporation tax, corporate tax, call it what you will, is based not on accounting profit, but rather on taxable profit. Now, what are these adjustments that I'm making to turn accounting profit into taxable profit? Well, these adjustments are necessary quite simply because of differences that exist between accounting rules and taxation rules. So there are some things that go on in the accounts that are just not permissible, not allowable for tax purposes. Now, the ins and outs of this will depend on the particular country that you're dealing with, the tax jurisdiction thereof. And so we don't need to go into that, as I explained earlier. Suffice to say that differences exist between accounting rules and taxation rules, and that's why we have to make these adjustments. So what sort of differences? Well, again, I come back to my earlier point. It will depend on the tax jurisdiction that you are operating in. But there are some things that are common to, shall I say, most tax jurisdictions. Arguably, the most common difference between accounting profit and taxable profit in most countries lies in the area of depreciation. Now, we all know what depreciation is. Yeah, we all know the purpose of depreciation, and we all know that depreciation is a perfectly valid accounting expense. The depreciation charge for the year is deducted in arriving at the profit. Perfectly valid accounting expense. But in most tax jurisdictions, depreciation is not an allowable expense for tax purposes. It is not deductible in arriving at taxable profit. You do not get tax relief on the depreciation expense. So one of the adjustments that you have to make to convert your accounting profit into taxable profit is to add back the depreciation expense. So maybe that's what that first X is there, adding back the depreciation expense. Now, does that mean you don't get any sort of tax relief at all for the writing off of your non-current assets? Well, you do. In the UK, we call it capital allowances or writing down allowances. In other tax jurisdictions, you might hear the phrase tax allowance on the asset, tax allowable depreciation, tax depreciation. What does all of that mean? Well, it's basically depreciation, but not based on the methods and the rates that the company itself is using in its accounts, but rather based on the methods and rates that are predetermined by the tax authorities. So it might be that a particular asset in the accounts, you are depreciating straight line over 10 years, but the tax jurisdiction of the country that you're operating in offers you a tax allowance, capital allowance, call it what you will, based on an entirely different way, maybe 25% reducing balance or something like that. So it's tax allowable depreciation. Maybe that's what that minus is there. So one of the key differences, one of the key adjustment areas in converting your accounting profit into taxable profit is that you add back the depreciation expense, which has been charged in the SPL, and deduct in its place the tax allowable depreciation, which I'll refer to from now on using traditional UK terminology as capital allowances, But you can substitute whatever phrase, whatever terminology you are familiar with, depending on your jurisdiction and what you're studying. Okay, so that's one, arguably the most common difference, depreciation versus capital allowances. There is another one that is common in many tax jurisdictions, and that's certain types of entertainment expenditure. Perhaps non-staff entertainment. Maybe you take a client out to lunch. Well, that expense is a perfectly valid expense in the accounts. It is deducted in arriving at PBT in your SPL, but it is not allowable for tax purposes in most jurisdictions, as I said. So perhaps that's what that X there is, adding back the disallowable entertainment expenditure. So what we've got so far is, in principle, we have these differences between accounting rules and taxation rules. And because of these differences, in order to work out your taxable profit, you need to start off with your accounting profit and you need to make adjustments, add some things take some things away. Let's take it one step further. These differences that I am representing by those X's there, they can actually be classed under two headings, and that is temporary differences versus permanent differences. So temporary differences versus permanent differences. What is this all about? Let's talk about temporary differences first of all. Temporary differences traditionally used to be referred to as timing differences. You might hear that terminology, timing differences, temporary differences, pretty much the same thing. What are they? Well, the idea behind a temporary difference is that you have an item. Now, when I say an item, I'm referring to an item of income or an item of expense, a gain or a loss. Yeah, there's an item, and that item passes through both accounting profit and taxable profit. It passes through both of them, but not in the same year. We're talking here about a gain or a loss, an income or an expense that goes through one of the profits in one year and it goes through the other one in another year. Classic example of a temporary difference is what I was talking about earlier, depreciation versus capital allowances. Let's say, for the sake of the argument, you have an asset here. Oh, as I said, live and unedited, live and direct. As you can see, my pen has gone on the fritz. Let's try that again, take two. Okay, so here is an asset. It's some sort of non-current asset. It could be a machine, whatever. Let's say for accounting purposes, oh, and incidentally, going back to the asset, we need to give it a cost. I'm going to use dollars just for international reasons, as it were, but feel free to substitute whatever currency is appropriate to you. Let's say the cost of this asset was 10K. Now, as I was saying, for accounting purposes, perhaps this asset is being depreciated straight line over 5 years. Right, so just simple straight line depreciation over 5 years, that's going to be 2K every year. Perhaps for tax purposes, in the jurisdiction in which this particular company operates, the tax authorities allow capital allowances, tax allowable depreciation, whatever you want to refer to it as, maybe at the rate of a straight line over 4 years. Okay. Let's model this. We've got the 5 years. 1, 2, 3, 4, 5. So that's the year. Accumulated depreciation, that's what's in the accounts. Accumulated CAs, capital allowances. As I said earlier, I'm using UK terminology, but what I mean by capital allowances is tax allowable depreciation, both on an accumulated basis. So in year one, we're looking at 10K divided by 5. That's going to give you 2,000 of accounting depreciation. 10K divided by 4, you're looking at 2,500 of capital allowances. In year 2, in the accounts, we're going to charge another 2K of accounting depreciation. Cumulatively, then it's up to 4K. In the tax computation, we're going to charge another 2,500 of tax allowable write-off. So cumulatively, we're looking at 5K. Year 3, another 2K of accounting depreciation goes through the accounts. Cumulatively, we're at 6K. Yeah. In the tax computation, another 2,500 of capital allowances go through. Cumulatively, we are at 7.5K. Now, as you can see, what's going on here on a cumulative basis is that the capital allowances are way ahead of the depreciation. Now, I mean, but I've stopped there at year 3, and you can see cumulatively in the accounts, 6K of the asset has been written off, 7.5K of the asset has been written off for tax purposes. Yeah, so the capital allowances are running ahead of the depreciation, a phenomenon often referred to as accelerated capital allowances or accelerated tax allowances. Okay, so at the moment, the capital allowances are running ahead of the depreciation, and that continues into year 4 as well. Year 4, another 2,000 of accounting depreciation, so cumulatively we're up to 8K. Capital allowances, another 2.5. Cumulatively, we're up to 10K. Now, at that point, the capital allowances stop. In the tax computation, the asset is fully written off at that point. Yeah. So, and in the accounts, it isn't fully written off. We've only got 8K of accumulated depreciation. The depreciation currently is running behind the capital allowances. But what happens in the final year? In the final year, as you can see, it catches up. Yeah. Now, ultimately, at the end of this, if you consider the whole period under review here, is it not fair to say that 10K is going to be written off in both the accounting profit and the taxable profit? The entire asset will be written off in both. It's just going to take 5 years from one point of view and 4 years from another point of view. But the entire 10K of asset, the entire 10K expense will pass through both accounting profit and taxable profit, but not in the same year. To begin with, the depreciation is running behind the capital allowances, but given enough time, the depreciation catches up. The temporary difference is said to reverse. Okay, but ultimately it is the same 10K passing through both accounting profit and taxable profit. It's just in different periods. A nice analogy that I often use when I'm talking with my students in this particular area, I'm sure that, well, I suppose, depending on what country you were brought up in, you might be familiar of the early years story, as it were, the tortoise and the hare. Yeah. For those of you that are unfamiliar, I'll give you the abridged, shortened version. You've got a tortoise. Now, hopefully, we all know what a tortoise is. You've got a hare, which is basically a large rabbit. Now, as we know, tortoises they walk very, very slowly. Hares they run very quickly. Now, this particular hare was a little bit cocky, shall we say, and one day challenged the tortoise to a race. Now, you might think, well, no chance. Yeah, it's a foregone conclusion. Anyway, they line up at the start line. The starter's gun goes off. The race commences, and as one would expect, the hare is way, way, way ahead. Yeah, so far ahead that the hare decides, do you know what? I'm not going to get caught. I'm going to sit down. I'm going to have a little rest, and that little rest turns into a little nap. The hare falls asleep, and while the hare is asleep, slowly but surely, the tortoise is catching up, and eventually passes the hare and wins the race. There's a moral to that story. I'll let you figure that out for yourselves. But the analogy, going back to my previous screen, hopefully you've picked up on the analogy. The capital allowances of the hare, yeah, they're running ahead to begin with. But at the end of year 4, they stop, and that allows the depreciation, the accounting depreciation, to catch up. In this case, ultimately, it's a dead heat. No one wins. But get that idea of the temporary difference reversing, the tortoise catching up to the hare. It's a nice analogy to have in your brains when you're figuring out deferred tax. Okay, so that's a temporary difference. When the same amount, in my example, 10K, is passing through both accounting profit and taxable profit, just not in the same year. Contrast that with a permanent difference. A permanent difference, as the name suggests, is permanent. We are looking here at an item that passes through one of the profits, but never ever through the other profit. Typically, it's something that goes through accounting profit, but doesn't go through taxable profit. And the example, or what I said earlier about the disallowable entertainment expenditure. You've got here an example of an expense that goes through accounting profit. It gets deducted in the statement of profit or loss, but it just doesn't pass through taxable profit. It goes in one and not the other. The difference is permanent. Now, why am I focusing on this distinction between temporary differences and permanent differences? Well, when it comes to the discussion on deferred tax, it's very important to appreciate this difference, because deferred tax is a special accounting adjustment that we make in respect of temporary differences only. Deferred tax is all about temporary differences, not permanent differences. So let's actually do some numbers on this. Now I'm going to flick over to this screen here. I'm going to introduce you to the first of two examples. Now at this point, it might be a good idea just to pause the video and get your phones and take a photo or a screenshot so that you got the data to one hand, because the data will be disappearing once I flick back onto the screen that I was writing on. So this is the data that we're going to be using. Let's give it a quick read while I'm here. As I said, feel free to take a photo or a screenshot while I'm talking, or if you want to pause it, of course. Yeah. So we have a company commenced trading on the 1st of January 20X1. That's just a made up year. So brand new company, first year of trading. The income statement, which is just another term that you might hear for what I've been referring to so far as the SPL, the statement of profit or loss. For the year ended 31st December, X1 showed a profit before tax of $300,000. So what have we got so far? They're a new company. They've done their accounts for the first year, and they've come up with an accounting profit of $300,000. That's accounting profit. Taxable profit could be very different, as we know, because of the differences that exist between accounting rules and taxation rules. But it goes on to say here that the only difference between this and taxable profit was that capital allowances, AKA also known as tax depreciation or tax allowances, for the year were $100,000 greater than depreciation. All right, so that's the only difference in this particular exercise. The capital allowances are running ahead of the depreciation to the tune of 100K. And then finally, tax rate there is 30%. Now, based on this data that we've got so far, if I can say accounting profit, 300K, so just working in thousands of dollars. Now, to turn that into taxable profit, what am I going to have to do? Well, I'm going to have to add back the depreciation expense. Now, I don't know what that is. Yeah, let's just call it X. In its place, I'm going to deduct the capital allowances, which are 100 more than the depreciation. So I'm going to deduct X plus 100, thus converting my accounting profit of $300,000 into a taxable profit of $200,000. Okay, tax rate, I don't recall if I pointed it out, but it's there, it's 30%. Now, let's go and analyze this data in a bit more detail, and we'll learn about current tax and, more importantly, deferred tax. I'm going to set up two columns, one representing what I'm going to call the accounting SPL. So this is what's happening in the statement of profit or loss. This is what's happening in the accounts, in the financial statements. And then over here, I'm going to call this column tax comp. So this is the tax computation, working in thousands of dollars, as you can see. My starting point in the accounts is the accounting profit, PBT, 300K, as per the earlier data. In the tax computation, now the tax computation is outside of the accounts. It's done by another department, should we say, the tax department, right? They're not going to be working with accounting profit. What they're going to be working with is taxable profit, which, as we saw a little while ago, is 200K. Now, what I'm about to say here is a gross simplification, but it's good enough for the purposes of a financial reporting discussion. The taxable profit, 200K, just apply the tax rate, easy, yeah? And that gives you the tax, let's just call it the tax that is due for the year, 60,000. Now this tax this 60K that I've just worked out, as I said, is worked out by, let's think of it as another department, the tax people. It's completely outside of the financial statements, completely outside of the accounts. Thing is though, having worked it out, the tax for the year constitutes an expense that needs to be charged in the statement of profit or loss. So yes, it's worked out outside of the accounts, but once we've got the figure, we then need to bring it in to the accounts and charge it as an expense. So here's a 60K expense. I'm going to call it tax. Under proper IFRS terminology, it's the income tax expense, as you probably know. So that gives you a PFY, a profit for the year, basically the net profit, for the company. It's 240K. Now, I picked up that 60 from this external source, what I'm calling the tax computation, which external in the sense that it's outside of the accounts. And then I put it into the accounts. I charged it as an expense. In terms of double entry, bringing in the dreaded debits and credits, you are going to debit a tax expense, representing the expense in the SPL. The other side of the entry, well, in most jurisdictions, the tax for the year isn't going to be paid in the year. Typically, it's going to be paid next year. So what you're going to have at the year end, and this is an entry that goes in at the year end, is that you're going to have some sort of liability for unpaid tax. Current tax liability is where the credit goes. And that really is all that current tax is. Current tax is just based on your tax computation, based on the tax rules. How much tax do we owe? Based on the tax rules in this particular country that we're operating in here, we owe $60,000 and we are expecting to pay that in the very near future. We are expecting the tax authorities to issue us with an assessment saying you owe us $60,000. Current tax liability just based on your tax computation, easy. Now, this all sounds very reasonable so far. I've worked out the tax for the year, it's 60, I've stuck it in the accounts. Easy, reasonable. What's the big deal? Well, I'll tell you what the big deal is. What we've actually done there is in breach of one of the most fundamental accounting concepts, probably, arguably, the most fundamental accounting concept. Let me write this down. Problem. You might have figured it out. You might want to pause the video and give it a think. The problem is matching. Matching is part of the accruals concept. We know that when you measure profit, you're supposed to charge expenses against the income to which they relate. We have failed to do that here. What we have between these two figures is a complete mismatch. Because what we've done is that we've charged an expense of 60 against a profit of 300. But that expense of 60, it doesn't relate to a profit of 300, it relates to a profit of 200. Because of the differences that exist between accounting rules and taxation rules, we've got a situation where 100 of profit has passed through the accounts, but it hasn't passed through the tax computation. I'll repeat that because it's important. Because of the differences that exist between accounting rules and taxation rules, we have a situation where 100 of profit has passed through the accounting SPL, but has not yet passed through the tax computation. I use the word yet there in passing. Yet is an important word. I said it hasn't yet passed through the tax computation. But if you think about it, that 100 of profit will eventually pass through the tax computation. When what happens? Pause the video and think about that question. What's causing this problem in the first place? What's causing this problem in the first place is that the capital allowances are running ahead of the depreciation. But eventually, what's going to happen? Eventually, the tortoise is going to catch up. Eventually, the temporary difference is going to reverse. What I'm saying is, given enough time, the depreciation is going to catch up to the capital allowances. And when that happens, which will be in future years, the extra 100 of profit that is in the SPL today will feature in a future tax computation. Problem is, though, we can't wait for that to happen. We can't wait for that extra 100 of profit to pass through the tax computation because it's in the P&L this year. We've registered, recorded that extra 100K of profit in the P&L this year. And so for matching purposes, we need to recognize the tax this year as well, even though that tax won't crystallize until the 100 passes through the tax comp, which will be, as we've said, in future years. To cut a long story short, what I'm saying is that 60 is not a very good match against the 300. What would be a better match rather than 60? Perhaps 90? Yeah? So the problem is matching. Tax charge is too small. Well, if the tax charge is too small, the solution, quite simply, is to accrue some more tax. You are going to take the amount of the temporary difference, which is 100K, you are going to multiply it by the tax rate, 30%, and that is going to give you an extra 30K of tax expense to accrue. Let me draw up once again just the SPL this time, so just the accounting statement of profit or loss. Again, I start off with my PBT, my accounting profit before tax, 300K. Again, I'm going to charge a tax expense against that profit. My tax expense now is going to consist of two elements. We got the 60 from earlier that we know about, the 60 that we saw up here. But we've also got an extra 30 that I said I'm going to accrue for matching purposes to give me an altogether more sensible 90, yeah, to match perfectly against the 300 there. And that gives me, therefore, a PFY, a profit for the year of 210. Now, how am I going to get this 90 into the books? Well, 60 of it I've already discussed. Yeah, 60 of it, as we saw up above, I won't scroll up again. You are going to debit your tax expense and you are going to credit what I referred to earlier as the current tax liability. And as we said, the current tax liability is what you actually think is due and payable based on your tax computation, based on the tax rules. What about this extra 30? How are we going to get this in the books? What we're going to do with this, again, I'm going to debit my tax expense. Yeah, because it's additional expense for the year. It's the credit side that's a little bit more interesting. Am I going to credit a current tax liability? Another way of asking that question is this additional 30 due and payable now? Am I expecting the tax authorities to send me another letter saying, right, you need to pay another 30 now? No. This liability, this extra 30 is not due and payable yet. It hasn't crystallized yet. When will it become due and payable? Well, at some point in the future, when the extra 100 of profit that has already been recognized in the SPL, as we said, in future years, will pass through the tax computation when the temporary difference that caused it reverses. In other words, when the depreciation eventually catches up to the capital allowances. Right? So the point is, this is not a current tax liability. What this is, it's a potential future tax liability. It is not a current tax liability, it is a deferred tax liability. And that is all that deferred tax is. It's an additional tax liability that you put in for matching purposes, really to obey the accruals concept. If you understand this, you understand the reasoning behind deferred tax, the need for deferred tax. It's an accounting adjustment. that is needed for matching purposes so that you end up with a sensible tax expense in your SPL. That's all it is. As I said at the start of this video, deferred tax is often unnecessarily made a meal of. It's often taught in books and in lectures in a very difficult way. Yeah, it's actually taking something that's reasonably straightforward and making it unnecessarily difficult. Rewind the video, watch again up to this point. Make sure you understand the reasoning behind that additional 30. And this whole area of deferred tax is only applicable for temporary differences, because because what you're doing by applying deferred tax is that you're kind of taking future tax and bringing it forward for matching purposes. Temporary differences reverse, therefore temporary differences have a future tax consequence, whereas permanent differences do not have a future tax consequence. They don't reverse, as it were. That's why deferred tax is only for temporary differences, not for permanent differences. Right, deep breath, let's carry on. Let's go back over here. I've got another example. And again, I'm going to suggest you do the same thing. Maybe just pause the video, take a photo so you've got a record of the data, a photo, a screenshot, whatever you want to do. This follows on from the one that we've just done. Following on from example one above, we are now, as you can see, 1 year later, 31st December 20X2. The property, plant and equipment, PPE, as it's commonly referred to, you might be familiar with the idea of tangible assets, yeah, tangible fixed assets, perhaps. Different terminology in different countries. The internationally recognized terminology is property, plant, equipment, PPE. A discussion for another day under IAS16. Anyway, we're in the second year now, 31st December X2. Property, plant and equipment of the company was reported on the statement of financial position, the balance sheet, if you like, at a carrying value, carrying amount, net book value, NBV, call it what you will, $1 million. Right, so the PPE, as at 31st December X2, in the accounts, on the balance sheet, on the statement of financial position, as it says there, $1 million. For tax purposes, these assets had a written down value of $850 at this date. Okay, written down, let's actually summarize this a little bit. I'm just going to do it in the space here. Should be more than enough. So we're now at 31/12/X2. It's now the next year. And we've been given some information about PPE, property, plant and equipment. We've been told that the PPE has got an accounting net book value, otherwise known as the carrying value or the carrying amount, $1 million. I'm going to work in thousands here. So that's going to be 1,000. Whereas the same PPE on the same day has actually got a tax WDV, tax written down value, of 850. Now, what do we mean by tax written down value, tax WDV? Well, this is the tax version of the net book value. So the net book value, the accounting carrying value, is the cost of the assets minus the accumulated depreciation. Whereas the tax written down value is the cost of the assets minus the accumulated capital allowances, the tax allowable depreciation instead of the accounting depreciation. Simple as that. So it's like the tax version of the net book value. If you were to look at the regulations on this, in particular, I'm thinking about the international standard IAS12, they use this phrase, a phrase that you might see when studying deferred tax, and that is tax base. The best way to understand this idea of tax base, think of it like this. It's the tax version of the balance sheet. Yeah, the tax version of the statement of financial position. I'm going to use the abbreviation SOFP. It's a generally recognized abbreviation, right? So the tax version of the SOFP. What do I mean by that? Well, what I mean is, if you were measuring your assets and your liabilities using tax rules rather than accounting rules, what would you be reporting on your statement of financial position? Yeah? So I'll repeat that. If you were using tax rules instead of accounting rules to measure your assets and liabilities, yeah, that's the idea of tax base. So if we were using tax rules to measure the PPE, well, then they would appear in our financial statements at 850 rather than at the correct figure of 1 million. Okay, now there is a difference of 150k. Why is the tax base 150k lower than the accounting carrying value? Well, surely it must be because the capital allowances to date, or tax allowable depreciation to date, if you prefer, is greater than depreciation to date. And when I say depreciation to date, accumulated depreciation, I'm talking about accounting depreciation. Yeah. So the tax depreciation cumulatively is 150,000 more than the accounting depreciation. That must be why there is this 150 difference. Another way of thinking of that, what we could do is that we could call it the cumulative temporary difference. So cumulatively, yeah, temporary difference is now 150. Whereas last year, that temporary difference was, let me remind you, where is it? Here it is here, 100, yeah? Now what's happened in the second year is that that temporary difference has grown. It's gotten bigger. So if the temporary difference has gotten bigger, what do you have to do to the deferred tax? You have to increase the deferred tax. The tortoise hasn't started catching up to the hare as yet. The hare is extending its lead. Sorry to keep referring back to that analogy, but it's quite a nice analogy. So cumulatively, the temporary difference has increased, and that means we need to increase the deferred tax liability. We need to increase the deferred tax liability to a new figure of, well, you can see what I'm doing here, times 30%, 45. So that 45 is the required closing, I'm going to use DT, deferred tax abbreviation there, the required closing DT liability at 31st December X2. Now I've chosen the words very carefully there. It's the required closing deferred tax liability. I am not suggesting that we need to account for another 45 of deferred tax. I am suggesting that at the end of this year, the deferred tax needs to be 45. Bearing in mind that we've already got, if I may, where is it? This file here. Yeah, bearing in mind that we've already got brought forward from last year 30k of deferred tax liability in our books already. Yeah, so going back to this screen, if we compare to opening DT liability, 30, it means that in this second year, therefore, there is a required increase of 15. Yeah, a required increase to the DT. And it's that 15 that you would account for in the second year. So what you would do with that 15 is that, well, you're increasing the liability. So that's going to be a credit. You are going to credit the DT liability. And then the other side of the entry is going to go to tax expense. And on a practical level, when you are accounting for deferred tax on an ongoing basis from one year to the next, this is all you're interested in, just the movement in the year. Yeah. So in this particular year, we needed to increase the deferred tax liability. Other side of the entry goes to the tax expense. Yeah. In other years, you might need to reduce the deferred tax liability. Well, again, the other side of the entry would be to tax expense. Yeah, the double entry will be the other way around. If it was a required reduction, a required decrease, it will be debit the liability and then credit the tax expense. So to repeat the point again, well, if you're just accounting on an ongoing basis for deferred tax from one year to the next, You're just interested in what do I need to do to the deferred tax liability in the year? Do I need to increase it? Do I need to decrease it? And then generally the other side of the entry will be with the tax expense. I say generally because there are instances, which we won't go into in this presentation, but you might see in your studies, where you have to account for deferred tax to do with an item that is not in profit, but rather is in OCI, other comprehensive income. For example, deferred tax on a revaluation of PPE, something that you might encounter in your studies. Well, if the deferred tax is to do with an OCI item, well, then the other side of the entry would be in OCI rather than the tax expense which hits the SPL. Okay. So this is the implication for the second year. You are going to increase the liability. Other side of the entry is with the tax expense. What we've got so far, as a result of these two exercises that we've done, I haven't highlighted it as yet. I've been saving it until now, but there are actually two ways of viewing the same temporary differences, and that is you can view them from what I call a sort of P&L perspective, yeah, which is what we did in the first exercise. If I go back over here, so when I say a P&L or SPL perspective, whatever your chosen terminology is, I mean comparing accounting profit versus taxable profit. Yeah, and that's what we did in the first exercise, and you could see that because of the 100 of temporary difference, it gave rise to this problem in the tax expense that we had to fix by providing for deferred tax. So that's one way that you could view these temporary differences from what I call a kind of profit view, P&L, SPL view, call it what you will. Yeah, accounting profit versus taxable profit. But these same temporary differences can be viewed from a balance sheet perspective, a statement of financial position, soft P view, yeah, by comparing the accounting carrying value in the case of example 2 here, and in the case of PPE, $1 million, versus the tax base. I mean, if you think about it, this 150 difference that we've got here, another way of looking at this is, what does it mean for profit? Well, it means that cumulatively, to date, your tax depreciation has been 150 more than your accounting depreciation. Well, that means then that your taxable profits cumulatively will be 150,000 less than your accounting profits to date. Yeah, so it's the same differences, but viewed either from an SPL view or a soft P view. Yeah, a P&L view or a balance sheet view, if you like. I'm only mentioning this because if you study the international standard IAS12, IAS12 takes this, what I call balance sheet view, soft P view. It talks about accounting carrying values versus tax base. In my personal opinion, even though that's perfectly valid and correct, it's difficult to actually see the problem if you're looking at things from a soft P balance sheet perspective. It's much easier to understand the reasoning for this deferred tax and to actually see the problem when you look at it from a P&L view, which is what I did in the first exercise. Yeah, because you can actually see the mismatch. You can see the problem that deferred tax is trying to fix. But be aware there are two ways of viewing the same temporary differences, either from a profit view or a sort of assets and liabilities balance sheet statement of financial position view. On that note, I am going to give you a little rule of thumb that might be useful for you, and it's I think it works in most deferred tax situations. Let's call this a summary view. Summary view. I told you this was a live recording, not a summary view. A summary rule. That's better. Right? I'm going to say a DT, deferred tax, liability, underline the word liability, you'll see why in a moment. A deferred tax liability arises if, due to temporary differences. Now this rule, I can finish it off in one of two ways. Going back to what I said a moment ago, I could finish it off using a kind of SPL view, or I could use a soft P view. Well, in fact, I'm going to do both, yeah, for completeness. So a deferred tax liability arises if, due to temporary differences, well, let's say statement of profit or loss, SPL view, a deferred tax liability will arise if your accounting profit to date, yeah, this is all based on cumulative, so to date, is greater than your taxable profit to date. Yeah, so if your accounting profit to date is greater than your taxable profit to date due to temporary differences, a deferred tax liability is going to arise. The same rule from a soft P, statement of financial position, balance sheet view, is that a deferred tax liability will arise if, due to temporary differences, the accounting carrying value of net assets is greater than the tax base of those net assets. Tax base, remember we said earlier, is the tax version of the soft P. By that I mean if you were measuring your assets and liabilities using tax rules rather than accounting rules. Now, the SPL view was illustrated in the first exercise. We had, now remember in the first exercise, it was the first year of trading. So the figures for that year were the cumulative, they were the to date. So we had accounting profit to date, 300. We had taxable profit to date, 200. And we saw how the need for deferred tax arose there. Yeah. The soft P view was illustrated in the second exercise. We didn't have all the assets and liabilities, but we had PPE. And with the PPE, accounting carrying value, well, it was 1 million, but I was working in thousands. That's why I put the 1,000 there, compared to tax base, 850. Yeah, and again, that created a need for a deferred tax liability of 45 in total at the end of the year. So that's a summary rule, as it were, bringing everything together, which you might find useful when you're dealing with deferred tax. Now, here's an interesting point. You can see I've got those greater than signs there. What if I flip those around? What if the temporary difference was the other way round? Let's add that in. Maybe not in blue. Let's do it in black. I'm going to say if other way round, then what you're going to have, pause the video, have a little think. If other way around, then DT asset. Yeah, it is possible to have a deferred tax asset. Yeah. Going back to the first exercise, if we had a situation where the temporary difference was the other way around, so let's say for argument's sake your taxable profit might have been 400, yeah, instead of 200. Well, then that would have, if we apply 30% to that, it will mean that you'll have 120 of taxes due. Yeah, so you will put through an expense that is too big for your P&L. Again, it doesn't match properly. That tax expense, 120 now, is too big. You're going to have to make that tax expense smaller for matching purposes. You are going to credit the tax expense to make it smaller. The other side of the entry, the debit, creates a deferred tax asset. Yeah, so be aware that although in a kind of study scenario, when you're maybe studying for professional exams or maybe undergraduate exams, more likely you're going to see a deferred tax liability, I would say, be aware that there is such a thing as a deferred tax asset if the temporary differences are the other way round, as I said. And on that note as well, some terminology that you might encounter if you're studying IAS12. Terminology. Taxable temporary difference. You might hear that, taxable temporary difference. What does that mean? Well, what that means is basically what I've set up here. Yeah, I'm just going to have the sign that way around, indicating, yeah, it's what I've spelled out here. If the temporary difference is this way around, yeah, it's known as a taxable temporary difference. So that's what we've seen in the two examples, taxable temporary differences. Yeah, and that gives rise to a DT liability. The other phrase you might hear is a deductible temporary difference. Now, a deductible temporary difference, quite simply, it's the other way around. That's what I was talking about a moment ago. And that would give rise to a DT asset, deferred tax asset. So if you hear this terminology, taxable temporary differences, deductible temporary differences, don't panic. It's just a way of describing the direction. So the direction that we've seen in my examples have been taxable temporary differences. That gives rise to a deferred tax liability. But if it's the other way around, it's just called a deductible temporary difference, and that gives rise to a DT asset. One final thought before we call it a day on this video, in terms of the practicalities of how you might see this in a question, particularly if you're studying something that is assessed through like an OT question, a multi-choice question, something like that, which increasingly professional exams are. Let's say we've got the following situation. I'm going to open up some dreaded T accounts here. They're not going to be a work of art. They don't need to be. So here are 3 T accounts. Yeah, first one is your tax expense. The second one is the CT liability. So this is the current tax liability. And the third one is the DT liability, the deferred tax liability. Now let's say the question says that for this particular company, they've done their tax computation at the end of the year, and they have assessed that the tax that is due for the year is £50,000. So in terms of double entry, what's going to happen is this. You are going to place a 50,000 debit in your tax expense, and you are going to place a 50,000 credit in your tax, your current tax liability. So just accounting for this year's tax based on the tax computation, debit the tax expense, credit the current tax liability. Now, let's say, brought down, there is currently a deferred tax liability of 100,000 in the books of this company. And the question tells you that the required deferred tax liability at the end of the year, so carry down over here, is 120,000 for argument's sake. It might tell you that directly, or it might give you some data which enables you to work that out, the required closing deferred tax liability. Now, what is this telling me? What this is telling me is that therefore the deferred tax liability needs to increase by 20,000. Double entry number 2 then, to increase the deferred tax liability by 20,000, I have to credit the deferred tax liability. Where does the other side of the entry go? Well, this is what we discussed earlier. From one year to the next, you're going to be changing the deferred tax liability up or down. Other side of the entry, in this case, a debit, because it's an increase to the liability, so the other side is going to be a debit, yeah, will go to tax expense. So over here, 20,000. Now I'm envisaging the requirement to this question being, what is the tax expense in the statement of profit or loss? Well, the answer to that question is the balance on this account. What's going to be transferred to the SPL is 70,000. thousand. So you can see how the tax expense for the year that ultimately features in the statement of profit or loss is made up of two elements. You've got the tax on this year's profits, the current tax, yeah, and then you've got the increase or decrease in the deferred tax, yeah, the 50K and the 20K respectively. And I think that's where we're going to call it a day. That concludes this introductory lesson on deferred tax. Now, the idea is this has given you a foundation, a platform that you can then build on using your own material, which is unique to whatever you happen to be studying. But hopefully this session has given you an understanding of what deferred tax is all about. And remember, if you like what you hear, hit like, hit subscribe. There will be many more videos to come in the coming weeks and months. Bidding you all farewell, ladies and gents. That's deferred tax.